Have you ever wondered how a $400 million development could transform a town's identity? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. Today we're diving into a significant new project in Castle Rock, Colorado. As reported by Justina Tomtas in the Denver Business Journal, a massive $400 million development is set to expand the downtown footprint of Castle Rock. Local leaders are hopeful that this ambitious project will finally establish Castle Rock as a standalone community, rather than just a bedroom town within Douglas County. This development aims to revitalize the area and bring in more residents and businesses, ultimately boosting economic growth. It's a bold move that could redefine Castle Rock's image and appeal, not just locally, but also in the broader Colorado region. By expanding its downtown, Castle Rock is positioning itself as a more attractive location for both residential and commercial interests. Now, let's draw a parallel to the Canadian market, specifically in the Kitchener-Waterloo area. Similar to Castle Rock's ambitions, Kitchener-Waterloo has been experiencing significant growth with a focus on expanding its urban core. The region has seen a surge in multifamily developments and commercial opportunities, driven by an influx of tech companies and startups. This has made it a vibrant hub for both living and business, much like what Castle Rock aspires to achieve. In both cases, these regions are capitalizing on their existing strengths and leveraging new developments to attract more investment and talent. It's a fascinating time for commercial real estate in both Canada and the United States, as cities and towns redefine themselves to meet the demands of the future. Now, shifting our focus to Denver, Colorado, recent reports by Jeannie Tobin from CoStar Analytics highlight a robust performance in the multifamily sector. The market recorded over $1.5 billion in transactions in the first quarter of 2025. Multifamily sales continue to drive the overall market volume, yet industrial and retail sectors are also gaining traction. This indicates a diversified interest from investors who are cautiously optimistic about the market's trajectory. The Denver market's multifamily growth reflects a broader trend seen in many North American cities, where urbanization and population growth fuel demand for residential units. In the Kitchener-Waterloo region of Ontario, Canada, the multifamily sector has similarly seen a boom, driven by a tech industry surge and an influx of young professionals seeking urban living. This has resulted in numerous new developments and increased investor interest, parallel to what's happening in Denver. Moreover, while multifamily remains a stronghold, industrial and retail sectors in both regions are not far behind. In Denver, industrial properties are experiencing increased activity as businesses seek logistics and warehousing solutions amid growing e-commerce demands. Similarly, in Kitchener-Waterloo, industrial spaces are being repurposed and developed to accommodate the burgeoning tech and startup scene. Retail in Denver is also witnessing a resurgence, with new projects and refurbishments enhancing consumer experiences and attracting foot traffic. This trend is mirrored in the Kitchener-Waterloo region, where retail spaces are evolving to include more experiential and community-focused elements aligning with modern consumer preferences. Overall, the commercial real estate landscape in both Denver and Kitchener-Waterloo is evolving, with multifamily, industrial, and retail sectors each contributing to a dynamic market environment. The comparisons between these regions underscore the cross-border relevance of current trends in commercial real estate, highlighting opportunities for investors and developers alike. Turning our attention to the Phoenix market, a report from Global Commercial Real Estate Services highlights a trend where office space conversions are outpacing new construction. Phoenix ranks 9th in the nation for the total square footage of office space earmarked for conversion into other uses, with approximately 3 million square feet across 15 projects. This reflects a broader national trend where more office space is being torn down or converted than built. Jessica Morin, Director of United States Office Research for CBRE, notes that while there are several buildings planned for conversion to apartments in Phoenix, the process can be challenging and costly. Many of these obsolete office buildings were constructed in the 1970s and 1980s and have large floor plates with only exterior windows, making them less suitable for living space. Despite these challenges, conversions can bring new vibrancy to neighborhoods by transforming vacant buildings into residential or mixed-use spaces. In Phoenix, notable conversion projects include the One Camelback project, which is transforming an office building into apartments, and the Phoenix Financial Center, set to be converted into a combination of hotel rooms and apartment units. Additionally, former office buildings have been converted into industrial or data centers, reflecting a diverse approach to repurposing office space. Interestingly, similar trends can be seen in the Kitchener-Waterloo region of Ontario, Canada. Here, the demand for multifamily units and tech-driven commercial developments is prompting innovative uses of space. Like in Phoenix, the Kitchener-Waterloo area is seeing conversions of older buildings to meet the needs of a growing population and a booming tech sector. This cross-border relevance highlights the adaptability and resilience of commercial real estate markets in responding to changing demands. Despite the high vacancy rates of office space, which stand at around 19% nationally, there is still active leasing activity, though the average lease deal is about 20% smaller than pre-pandemic levels. Businesses are increasingly seeking newer office spaces with modern amenities in desirable locations, a trend seen both in the United States and Canada. In a significant transaction, EQT Real Estate has completed a $128.2 million deal for an industrial property near Phoenix. This acquisition marks the largest industrial sale in the Phoenix area since 2023, surpassing BlackRock's previous record of $128.1 million by a margin of $100,000. This purchase reflects a robust demand for industrial spaces in the region, driven by factors such as e-commerce growth and logistical needs. EQT Real estate's investment is indicative of a broader trend where industrial properties continue to attract substantial investor interest. This aligns with a similar pattern observed in the Kitchener-Waterloo region of Ontario, Canada, where industrial spaces are also in high demand. In both regions, the industrial sector is benefiting from the expansion of e-commerce and the need for efficient supply chain management, making these properties a valuable asset for investors. The Phoenix market's activity in industrial real estate is mirrored across the border in Canada, where cities like Kitchener-Waterloo are experiencing a similar uptick in industrial property transactions. This cross-border relevance underscores the importance of industrial real estate as a critical component of the commercial market, providing opportunities for both local and international investors to capitalize on the growing demand. As we see these trends unfold, the industrial sector remains a focal point for real estate development and investment, highlighting its resilience and adaptability in meeting the evolving needs of businesses. The parallels between the Phoenix market and the Kitchener-Waterloo region offer valuable insights into the strategic importance of industrial properties in today's economy. In a recent development, Riverside Properties, based in Wellesley, Massachusetts, has acquired a 135,272 square foot office building located at 160 Gould Street in Needham, Massachusetts, for $19 million. This acquisition marks a significant discount from the property's previous sale price, reflecting the shifting dynamics within Greater Boston's commercial real estate market. The transaction was facilitated by Newmark, representing the seller, James Campbell Company, and procuring the buyer. The Boston Business Journal reports that the $19 million purchase price represents a steep decline from the $26 million paid by James Campbell Company in 2012, and an even greater drop from the $28 million sale in 2001. This depreciation over more than 2 decades highlights the broader challenges facing office markets across the region, with both pricing and occupancy under pressure. According to Samantha Hallowell from Newmark, 160 Gould Street is a historically strong performer in the area south of the Interstate 90/95 junction. It offers a stable in-place tenancy with potential for enhancement by repositioning its lobby and amenities to cater to modern tenant demands. The building's convenient location, just under 20 miles from downtown Boston, provides easy access to major highways and a commuter rail station, making it an attractive option for suburban space seekers. Tenants at 160 Gould Street include Leader Bank, the Bullfinch Group, the nonprofit Justice Resource Institute, Amparo Insurance, and First Help Financial. The property also features a former full-service cafeteria and an outdoor area, which present opportunities for future amenity enhancements. Despite the downturn in the Boston area office market, Riverside Properties is betting on a long-term recovery and the continued appeal of well-located suburban assets. The Boston Business Journal also notes that this transaction occurs amidst a broader downturn in the Boston area office market, with high vacancy rates and declining valuations becoming prevalent. Other deals, such as the recent $227 million sale of 99 High Street in downtown Boston, traded at a 17% discount from its price 2 decades earlier, further illustrating these market challenges. Despite these headwinds, Riverside Properties is focusing its investments on greater Boston suburbs, demonstrating confidence in the long-term potential of suburban office markets. As Boston faces potential budget shortfalls due to falling office values, the strategic acquisition of properties like 160 Gould Street may position investors to benefit from future market stabilization and growth. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.